Dear members, dear attendees, we would like to start first of all to thanking you for joining us, the Bahrain Economist Society, on our first webinar. It's been a while since we did an event. I know that you guys are used to us doing events every now and then. Currently with COVID-19, it's been a tough time for us to do any events, but we have a lineup of webinars coming up that will compensate for whatever time that we had. Plus, they are very hot topics and relevant at times like this. Now, the second thing is webinar today, event name is The Grand Disconnect Between Economics and Market. The title by itself is very captivating. I know a lot of people came up and asked about the title and what are you guys going to speak about. The title says it all. There's a disconnect between the economics and whatever is happening in the markets. And we have our host, M.R. Raghu, who is head of research at Kuwait Financial Center, Markaz. They are a leading asset management company based in Kuwait. They have assets under management of 3 billion. He's part of the investment committee as well, voting member. He's also a managing director of Marmore MENA Intelligence, which is a research subsidiary of Markaz. His career spans over 33 years. 22 of those 33 is in the region, specifically Bahrain, Kuwait, and Riyadh. He's a CFA holder, a certified financial risk manager as well. We are really lucky to have him. He's a founding board member of CFA Society Bahrain and founding president of CFA Society Kuwait. Both societies have their weight in the economy here. They help a lot. So he knows the region, he knows the world. We are really happy to have him speak in this event. I'll pass on to him to go through the presentation. If everybody can stay mute. If anyone has any questions, you can either post it on the chat and we'll take it up to Mr. Raghu, or you can wait till the end and just let us know that you need to ask a question through the chat and we can patch you in. We will write down the questions and then we'll ask him at the end of the period. Again, join me to welcome him in the first event that we have. And the floor is all yours, Mr. Raghu.
Thank you very much, Sami. I hope you can hear me, right?
Yes.
Very good. Welcome to all the participants. Good evening. It's been very interesting and difficult times for all of us. I don't think anybody would have ever imagined that this is going to go so much out of hand that it is getting very difficult to bring it back in whichever part of the world you are. So you know that COVID has already disrupted the scenario, and it is really wreaking a havoc as we speak. So many thanks to the Bahrain Economic Society and Ali for inviting me to talk to you about what I think is really happening. And I'm going to split my presentation into basically 3 parts. The first part would quickly explain from a health perspective what's happening due to coronavirus, both globally as well as in the GCC. And then I will shift gears to economics and explain as to what's the economic impact so far because of this virus. And then I will shift gears to markets. And then I will explain as to how the markets have reacted so far. And then I will explain the disconnect between economics and markets. And that's basically the main orientation of this presentation. And probably then we'll, as final thoughts, we'll try to guess some outlook scenarios. When I say markets, I will cover global as well as regional markets, because regional markets are of more interest to us. We are based in the region, and therefore we try to connect the dots between the two all the time. So let me start with the healthcare aspect. I would like to quickly explain as to how COVID has impacted us so far. So if we can move to slide 4. Yeah. So you can see that what started as a very small thing by the end of December actually ballooned so much today that we have about 13 million cases worldwide of people that have been affected by coronavirus. But the good news is more than half of them have recovered and they are fit and fine. Uh, the world has encountered about 500,000 deaths so far, but things are, the curves are at least beginning to flatten in many parts of the world. You can see that the aggressive testing, we have about 153 million tests conducted, which is about roughly 10 times the confirmed cases. But if you look at the inception of this problem, it actually started in China, but you can see that the curve for China is so flat and they have never been affected at all by this. And then you have surprisingly, US and Europe, which got severely impacted. So if you, probably the one confusing thing about this number of confirmed cases country-wise is that they are not apples to apples. Countries come in different sizes. As you know, China is the largest country, India is huge, Bahrain is very small. So we're talking about number of cases at an absolute level makes no sense. So we need to reduce that to a number of cases per million. And then you can see that on an average, we have about 1,700 cases per million in the world. So different countries now we can see with respect to this 1,700, are they better off, are they worse off? For example, India is about 643, which is far better number to look at. Whereas if you look at US, for example, they're about 10,246 per million, which is about 8 times higher than the average. The same thing applies for the deaths. The average death is about 75 per million, but then you have India at 17 and US at 400. So it's a very skewed picture as we speak globally. And, parts of the world that got seriously affected includes South America, North America, and Europe. Asia is relatively better off compared to these three regions. And if we move to the next slide, we can see the GCC statistics, which when compared to global, in my opinion, looks better. We have about 500,000 confirmed cases, mostly coming from Saudi Arabia and Qatar. And in terms of average cases per million, we rank very high. Compared to the global average of 1,700, we are about 10,000, which is a real bad news from a number of cases point of view. But if you look at the number of deaths, we probably are very low, because a lot of recoveries are happening and there is aggressive testing that we can see in relation to the way the GCC is handling this pandemic. So moving on, in terms of the flattening of the curve, you can see that different countries, GCC countries, are trying different methodology. I would pick UAE for the excellent management of COVID because of the aggressive testing. You can see that they have done about 3.7 million tests as compared to, say, Qatar, which did only about 416,000 tests. So it's about active testing and then controlling the confirmed cases and converting the confirmed cases to recovered cases and keeping the death toll to the barest minimum that is possible. So in terms of a comparison to GCC, I can see that UAE has set a very nice benchmark for others to emulate. So let's move. One very critical yardstick to look at would be the doubling time, the time it takes to really double for the confirmed cases. So the higher the doubling time, the better it is. And you can see here that Qatar's doubling time is the best. They initially had a very, very severe spike, but now they seem to be so much under control because of this spike in the doubling time. Whereas Oman has the lowest doubling time, which means the number of cases in Oman is growing much more rapidly than other countries. So you can see that after Qatar, UAE is also doing very well in terms of pushing up the doubling time. So the higher you push the doubling time, I think the slower would be the number of additions to the total number of cases. I think it's a very important metric to follow. So this probably, gives you the statistics as to what has happened so far. In terms of the virality of this virus, a lot of such epidemics have come, pandemics have come in the past, like for example, the H1N1 or the seasonal flu or the SARS or the MERS. So this compares very closely with the SARS in terms of its impact. Normally, it is estimated that a person who is infected infects about 2 to 3 others. Now they are saying they can potentially infect about 6 people, and the average incubation period is about 5.5. The problem here is that nearly 30% will not show any symptoms. So there is no way we can. That is why you will see countries doing very aggressive testing, and there is a possibility that it can relapse, and there can be second wave, there can be third wave, and some people are talking about herd immunity, which basically means that majority of your population gets it, and therefore it gets contained through that. Because once you get it and then you recover, you probably develop some sort of a resistance to the same virus. So, but we will shortly see how we are still not there in terms of herd immunity. So let's move on. So while it is a very severe pandemic, countries have responded quite well, in my view, rather swiftly. And the best example could be the US, which immediately, formulated the CARES Act and doled out about $2.2 trillion as a stimulus package, spread across a variety of sectors, including direct and indirect reliefs to businesses, small businesses, financial institutions, hospitals, and even a direct cash transfer to individuals to the extent of about $1,200. So not only US, if we move on, we'll see that most of the major developed countries like Germany or Japan have launched fiscal stimulus that are gigantic in proportion. When you compare this, the closest crisis that this is frequently compared to is the 2008 financial crisis. And you can see that developed countries are now, on an average, is having a fiscal stimulus that is of at least 5 to 6 times larger than the 2008 financial crisis. So Germany is a classic example. It's 10x compared to the global financial crisis, and the same thing with the Japan and UK and France, and to an extent US. So almost all the countries have responded to this crisis through a stimulus package that is phenomenally very, very high compared to the 2008 crisis. So, this, I cannot say the same thing for GCC. GCC barring Qatar, most of the stimulus comes only in the form of a monetary stimulus rather than fiscal stimulus. Now, there's a very big difference between the type of stimulus. There are essentially two ways in which you can support the pandemic. One through monetary policy, which is probably to reduce the interest rates, for example, or make sure adequate liquidity is provided in the system for banks to access. So these are monetary stimulus, whereas the fiscal stimulus is the direct cash hold out to individuals or to businesses. So fiscal stimulus results in fiscal spending, and it may balloon the deficits, and then it may force countries to borrow, or it may force countries to dip into the reserves, but it presents the best possible response. But when I scan the GCC, I find that most of them have taken the easy route of monetary stimulus, and they haven't gone into the fiscal stimulus as aggressively as the developed countries that we have seen just before. Let's move. So let's take stock of how the response to the pandemic has been so far. And there's a lot of hope that somehow or other a vaccine would be found in the next 12 to 18 months to contain this virus. For example, it took about 6 months to figure out a vaccine, and it took about 18 months to roll it out for H1N1. So basically, there are so many, companies that are on trial when it comes to inventing a vaccine. But having said that, this is a very slippery area of finding a vaccine for a virus like corona. Coming up with a vaccine can sometimes be a very long process. It can take about 5 years, and then it will be first tested on a clinical basis, and then some slow human experiments followed by a rapid commercialization after that. So it's not an easy road, though there are many, people claiming that, they will somehow find a vaccine in the next 12 to 18 months. So this is, as of now, is what is being touted, but I have my sincere doubts when I read articles by research institutions that are specialized in vaccines. So let's move. I made a point about testing earlier. I think this is very critical, and it's very heartening to see that Bahrain tops the list when you measure tests per million. Probably this is due to a very low population base of Bahrain. But I think aggressive testing is at the core of handling the problem. And countries that either are not financially capable of aggressive testing, or administratively, if it is very difficult to aggressively test, they will score very low on this. But we can see that most of the GCC countries are doing well when it comes to measuring on this performance metric, while countries like Egypt and India still lag. But GCC countries are very aggressive, and Bahrain is very much on top of the chart, as we can see here. So I made a point about herd immunity before. Herd immunity is simply that much percentage of population which should contract the virus for the virus to become ineffective. But you can see that we are far away from herd immunity. The suggested percentage for a herd immunity is about 60% to 80%, and we are about 10% now. So this is not getting anywhere closer to herd immunity. But if you look at US as a country and then look at the states within US, you can see that New York region is now about 35%, which is not far away from the herd immunity of about 60%. But globally, the chances of this coronavirus fading away because of herd immunity looks very remote, given the huge gap between what is actually the number of cases and what is required to really develop the herd immunity. Yes, so this is the healthcare aspect of coronavirus. Now I will quickly spend some time on the economic aspect. Obviously, this virus has done two damages. One, it destroyed demand because everything is locked down, and for the first time, at least in my life, I am seeing companies with zero sales for 3 months. So that has never been factored as a risk by any stretch of imagination, and it is happening as we speak. And the second problem or economic impact is the supply chain disruption. So you have a massive supply chain disruption. If the world transportation is on seas, and unless you can move, you cannot activate the supply chain. So you have a very low demand or a zero demand, and then you have supply chain disruption. So both has caused the global growth to really fall, especially in Q2. Towards the end of Feb or beginning of the March is when most of the countries in the world locked down. So the Q1 impact will be severe, but Q2 impact is going to be the yardstick or benchmark for the global growth. Of course, the fall in the global growth resulted in a rise in unemployment, and it affected sectors like retail, where there is a huge drop in the shoppers. So if we move, we will see that when you compare this global growth fall to the global financial crisis, you can see that both from a government debt point of view and from a fiscal balance point of view, this is far higher than what we have seen in 2008. For example, the fiscal balance dropped by 5% in 2008. Now it is dropping by 10%, which is probably double. So the monetary response has also been aggressive in terms of slashing of interest rates. You can see that there are countries like Turkey that slashed it by 2%, and then you have Canada, US that slashed by 1.5. So its interest rates are raising to zero all over the world, and they are expecting more to come. And so there are two things that are happening. One is you pile debt because of fiscal balance, and you keep reducing the interest rates to propel growth. So as we can move to the next slide, we can see that the GCC economic impact has been as severe as the global one. You can see that across the board, you will see the global growth has fallen in the past, and GCC is simply mirroring the same trend. What will happen is two things. One, GCC will have higher fiscal deficit across the board, as we can see in this chart, which will result in increase in the debt to GDP ratio for most of the countries, especially for Oman and Bahrain. And but there are other countries that can withstand this pressure because of the sizable reserves that they have. Next, please. So we have a severe economic impact. So how did that translate into stock market is the second question that we're asking. And as you can see, around March, middle of March, March 23rd to be very precise, that's when all the markets fell like a pack of cards. And then you can see that most of them have recovered very nicely. You can see, in fact, a V shape in this graph for markets. But look at China, for example, it's now on the positive territory because it never fell that much. As we can see that even the coronavirus impact for China has been very muted. But the worst market has been, for example, UK, Italy, France. They are still in the negative territory, though they have recovered quite a bit from their lows. S&P 500, which is the most followed index, is now minus 1% YTD. But at one point it fell 30% and then it rose to a similar extent so that now it is almost flat for the year. So it's a very uneven performance, and we can see in the next chart that the same thing happened for sectors as well. You can see that there are sectors that rebounded very nicely, like tech or healthcare, which is in the positive. And then there are sectors like energy and financials that are still under losses. And again, you can see a sort of a V pattern here, but a bit more uneven V compared to the market index that we have seen before. So if we move to the GCC markets, it's a bit of a different story here. As a response to Corona, the markets did fall quite steeply in GCC, but the recovery has been very, very muted. Dubai has been the worst affected. It fell almost 40% and it increased marginally to be minus 26 now. Qatar is now the best recovered market, followed by Saudi Arabia. But you can see that all of them are underwater and none of them are in the positive territory. And this will take us to the discussion on oil, which we will quickly come to. The same thing for GCC sectors. The best has been the non-cyclical sectors and the healthcare and telecom. These three sectors have escaped the wrath of Corona. Even though they fell by March, they quickly recovered ground. But you can see that sectors like financials, banks, real estate, and energy are still very much in the negative territory. So now the question is, when you have such bad economic numbers and when you have such a bad economic scenario, how is that global markets are recovering so quickly? This is probably the title of this presentation, and I'm making an attempt to answer that question. There's a very interesting poll that has been conducted on Twitter recently to find out what the traders are thinking about this as to why the markets are behaving differently from the economy. Most of them attribute this to the very strong Fed support. Remember, Fed supported 2008 financial crisis as well, and therefore 2009 proved to be one of the best years for markets, and the same thing is happening now. But more importantly, there is a big aspect to look at, which is in the form of the FAM stocks. What I mean by that is the bunch of technology stocks like Apple, Amazon, Facebook, Google, Microsoft, and Netflix. They together account for a lion's share in the S&P 500, and they probably led the recovery of the market big time. But when you look at their revenue profile, majority of the revenues come outside US, especially from Asia and Europe. And therefore, when we also observe that Asian and European markets have handled the pandemic a little better than US, and they have recovered sooner. And these companies benefited out of that trend. And that probably explains as to why S&P 500 has done much better in spite of very poor economic scenario for US. If we can also look at some other aspects. Of course, we know that Q2 is going to be very bad. We have started getting results. And there are some companies are surprising analysts by performing better, and other companies are going to be giving shocks. Q2, everyone has discounted Q2, Q3, and Q4. So the markets are now looking at 2021, and that probably is one reason why the markets are rallying in spite of the bad economic situation. And more importantly, as I explained before, the monetary and the fiscal stimulus measures are at least 10 times bigger than what we have seen in 2008 levels. So that must definitely support the market for a while. And the second aspect is the low bond yields. Now the bond yields are almost close to zero in US, and it's negative in Europe. And when bond yields are very low, you will not be able to turn away from stocks that easily. If you can see the formula for discounting, the yield comes as a denominator. So the lower the yield, the higher the value for either the market or for the company's stock price. So as long as bond yields keep going down, stocks will be very attractive. And there is also an argument that says that economic data comes with a lag, and it always is backward looking, whereas market looks forward, and therefore markets probably expect a V-shaped recovery. Markets probably think that things will come back faster than what we estimate, and therefore it is ignoring the bad economic numbers that we are seeing now. So in short, the market hates uncertainty more than bad news. And right now, there is more bad news than uncertainty according to the market. But let's see how this is going to impact the actual outcome. So in terms of commodity impact, because this is very important for us to understand in the region, we are very dependent on oil. And you can see that oil and gold are the two mostly tracked commodities. And gold has been always an insurance during crisis times, and therefore you can see that it has rallied the best, and it is up 19% for the year. And on the commodity side, we know the story about oil. Oil fell nearly 60% on the news of Corona, and then it recovered a bit, and it is now down 35%. Still a sharp enough fall for GCC economies to worry about. The rest of the commodity index is somewhere in the middle. So you can see that in case of oil, which is about $40 today, the two factors that influence the price of the oil are demand and supply. Now we know that we are in an excess supply scenario. The market sometime back, in fact, ran out of storage space, which pushed the oil price into the negative territory. But what I'm more worried about is the demand side of the story. As you can see in this chart, the fall in the demand has been so deep that it will take about October 2021 for the demand to come back to the pre-corona levels. So what we need to carefully watch for oil price movements is to see how quickly this demand is coming back. Because this is one variable that can really change the situation for the oil market completely. Moving on, as I talked about gold, gold is always an asset class that puzzles people because it's not an income producing asset class. I don't even know if people consider it as an asset class and provide an asset allocation very seriously, but it always surprises. And it has rallied about 27% during the last 12 months. And, the main gold moves inversely with the real yields. And there is a study which says that every 1% fall in the treasury yields will increase the gold price by about a fifth. But the speed with which the rally has happened in the gold, it has taken it to a frothy level. But people are not going to go away from gold in times like this, for sure. So that probably brings us to the last aspect of the presentation, which is the outlook for 2020 and 21. I would like to just tell you how severe the projections are from an economic growth point of view. The world GDP growth is expected to clock -5% from +3%. That's a huge swing, a swing that nobody has ever seen in our lifetimes. But the rebound in 2021 is also expected to be much better, mainly on the back of the low base in 2020. So you can see that emerging markets fare a bit better compared to the Euro area and the US, and especially China. Still, there is no negative growth for China. It's +1% and +8% for 2021. But India is going to be experiencing a sharp drop in 2020, followed by a very good rebound in 2021. So let's move. So what would be the outlook look like? There is a very interesting scenario analysis by McKinsey that I would like to show here. There are basically two possible scenarios. One is you contain the virus, and then the second scenario is the virus recurs. So within these two possibilities, you have a couple of growth scenarios where you have a muted recovery, you have growth coming back, or you have growth coming back with very strongly. So you can see that it lends to a lot of permutation combination, and how soon things will come back will depend on which combination you would like to put your bet on. And in any case, according to McKinsey, they classify this as A1, A2, A3, B1, and B2. So if you look at A3 as a scenario, which is the most optimistic scenario according to them, it's a scenario where you expect the virus to be contained and you expect the growth to come back. So if this happens, then we are talking about Q1 of 2021, which is not too far away. But look at scenario B2, which is the worst case scenario. And B2 is you have a virus recurrence and you have a slow long-term growth. So if that situation pans out, then you're talking about a recovery that is as far away as 2023 third quarter. So you can imagine the level of uncertainty in terms of recovery calls. So anything is possible, any combination is possible as of now, but let's hope for A3, but let's prepare ourselves for B2. So this is how I would look at these scenarios. Definitely, GCC is much better placed because except for a few countries like Bahrain and Oman, the rest of the countries are quite okay in terms of their debt profiles, and they have sufficient reserves cushion to handle this crisis on the fiscal deficit. Of course, we are talking about a large fiscal deficit for most of the countries, which means that they will have to dip into the reserves or they will have to issue debt. We are already seeing Saudi Arabia aggressively issuing debt, and we'll see reserves dipping faster. But the cushion is so large that it is definitely not a very bad news from a GCC perspective. As we move, we can see that as an asset class, as I explained to you before, the interest rates are falling. And once the bottom is reached on the interest rates, and if interest rates start to increase from this point forward, then you will have capital losses on bonds, which makes it an asset class with no positive expected returns. And most of the endowment institutions have a very large allocation to fixed income, and public pension funds still assume about 6 to 7% annualized return, which is practically impossible. So this will probably push a lot of liquidity and interest towards equity as an asset class, which can probably explain the party time that we are witnessing in the equity asset class. So moving on, we can notice that there is a lot of a time that we need for the oil price to recover, and for the oil demand to recover to support the price. The call of oil price is about $40 average for 2020 and about $50 for 2021. If these averages are realized, actually I'll be very happy. Because oil price swings can really be a very, very unpredictable swing depending on what type of impact it has on the supply and the demand, as I explained before. So as we move to the next slide, which is the final thoughts. So what I started the presentation by explaining the health aspects of coronavirus, how severe it is, which countries are handling it better, which countries are letting it go out of their hands, and what type of a scenario prevails in terms of a solution in the form of a vaccine. But then I explained the economic impact of coronavirus in terms of its impact on the GDP growth, on the fiscal deficits and debt, and what have you. And then we looked at the markets, which surprisingly seems to have rebounded much faster than what everybody expected. So you can actually see a V-shaped recovery in the markets, but not necessarily in the economies. And this is primarily being fueled by the huge liquidity injection by global central banks, which are 10 times bigger than the 2008 financial crisis. But as economic situation deteriorates, and probably there is a second wave of case threatening to come, things can get worse. And if, for example, we don't find a vaccine, because according to research, it takes a long time to find a vaccine. And if there is no herd immunity attained very quickly as well, then probably we have a disconnect. And the disconnect is very clear. You have a very worsening economic situation. And in that situation, one of the two things should happen. Either the economic situation should get better because of the central bank actions and the quick recovery of coronavirus, or the markets should converge back to normalcy and catch up with the economic reality, which means the market should fall. But we have also seen in the past that the economy and the markets can be uncorrelated for a very long time. Of course, in the very long run, they are correlated, but in the next 2 to 3 years, you might have a situation where the economy news gets worse, but the market news gets better thanks to the slosh of liquidity that prevails in the system, and also because of the bad aspects of other asset classes like bonds, which leaves very little room for people to chase yields and make some money. So as a concluding thought, I should say either the financial markets should fall or the economy should recover. It's your guess as well as my guess as to what will happen in which order. Let's hope that the economy recovers much faster and justifies the market valuation as of today, rather than the other way around, which can create a lot of wealth destruction. So that concludes my presentation, and I'll be happy to take some questions.
سامح.
Sorry, I thought I was on mute, but I am. Thank you very much for that presentation. It's really intriguing. You're making us think a lot about the recovery. Again, the most interesting thing to me was markets are looking forward while economic data is looking backward. That's something that I would think about a lot going forward, honestly. Now, we'll open the floor for questions. The first question would be from our president, Mr. Ali. Ali, can you give the mic? Can you unmute Ali, please? Thank you.
Thank you, Saleh. Thank you, Ali. Good evening, everyone. Your Excellency, dear guests, dear members, thank you for joining us tonight at this event. I'd like to extend our gratitude to Mr. Raghu for being kind to share his valuable insights on markets as well as economic thought at those unprecedented times. Raghu, my question to you is, within this pandemic, within this kind of environment, what would be the key challenges as well as opportunities for the GCC going forward?
The key challenge would be to really meaningfully support the recovery. I think what they've done so far is just pay lip service to the stimulus packages, which is mostly fueled towards the monetary support rather than the fiscal support. This pandemic created a problem which is both a demand side problem and a supply side problem, and a mere monetary policy support is not going to help, because monetary policy support takes a while before it hits the beneficiaries, whereas a fiscal support is immediate, and it can really bring back businesses, because it's nobody's fault that everything fell off the rails. And it's everyone's responsibility to bring the train back on the rail so that the train can start moving. So to me, that is the biggest challenge. They have the reserves, but they are not very sure if that is the path they should take. In terms of an opportunity, I would say that this is going to push the region into digitization that we have never imagined before. The adoption of digital initiatives by the government is so fantastic to observe. They are using technology to manage the problem, and obviously corporates' response to digitization has also been very good. We've all been working from home for a while, and we've used digital methods to be as productive and as effective as if we are in the office. So there are, of course, some sectors that can not participate in this digitization process, like, for example, real estate or retail or aviation, which are basically dependent on footfalls and stuff like that. But almost many other touch points can happen through digitization, and this region has been a bit slow in adoption of digitization, and now coronavirus is going to push people into that, and an young demography like this can easily adapt to digitization, and it will increase our productivity.
Thank you very much. Thank you.
Okay, so on the digitization point, I mean, this webinar wouldn't have happened. This pandemic
Exactly.
to a webinar, exactly. So this is a very good point. One question that I have is just like a comment or a question or something always on the back of my mind. I mean, since 2008, 2008 was like a too big to fail kind of problem. So they said it's too big to fail. Lehman Brothers failed, and they supported all the banking sector, the too big to fail. Now, a problem like this, it's like nobody should fail. So the UK economy is coming up and saying, listen, we will pay half of the bills of the food. They're reducing tax. As an investor, how should an investor look at an investment into a company? Do you analyze the company, or do you analyze the country which is it's residing in and backing it up going forward?
I think the basics of the investment theory will never change. You have to really look at the macro and then connect the micro. So
Yes.
that's, you cannot escape that even in good times or bad times. You need to really understand the economic environment and then connect the dots to the sectors and to the companies. But when you come at a company level, then you have so many variables to handle, because you might have a company in a bad sector, but it can be a very well governed company, and therefore it can get better valuation, and vice versa. You have a company in a very good sector but very badly run. So you have these variables that will play out at a company level, but at a macro level and a sector level, as we have seen in the charts, there are some sectors that completely escaped the COVID and did very well, in terms of its performance. And there are sectors which fell like a pack of cards and are unable to get up because of the very nature of the sector that we are talking about. So, the basics remain the same. You need to keep your eyes on the macro, because different countries follow different solutions to the problem. And we do not know which one is right and which one is wrong. For example, take Germany. Germany has spent about 33% of their GDP on fiscal stimulus, whereas India spent only 10%. So there is a lot of difference in how countries. I don't see a very coordinated approach. One big difference between global financial crisis and COVID is that global financial crisis, I saw some coordinated approach to towards a solution, because it attacks the financial system. So there was a lot of coordination between central banks when they acted in unison. Whereas in COVID, I don't see the coordination, and I see different central banks doing different stuff based on their own perception of the problem. So that can really be very important to consider, because there's no one size fits all approach here.
Yeah.
So we need to see who is doing what and take a call accordingly.
Good. Thank you. Again, we can't agree more. The pandemic is a tail event, so not everybody knows how to handle it. We have a couple of questions from the attendees. So the first question comes from Faris Hamami. He's asking, first of all, he's thanking you, and then and it's been very informative for him. So what would trigger the conversion of markets or economy?
I would say that probably the markets, because I'm amazed by the speed of the recovery. When you look at 2008 crisis, the markets tanked in response to that, but it took a while before the markets came back. Whereas in this case, the recovery has been so quick and so swift. And I don't know what is the basis of the swift recovery when half of the S&P 500 companies stopped giving guidance. I mean, I have never seen in my analyst life the companies stopping giving guidance, because the companies say that we don't know. It's so foggy that our factories are closed. Everything is stuck. There is no movement, and how can I give you a guidance? So for the first time in the history of S&P 500, you have bulk of the companies saying we can't tell you anything about the future. So in that scenario, if markets are rallying to where we have seen now, it can only be because of the slosh of liquidity that is going around, and we have seen that it is 10 times bigger than 2008 crisis. So at some point, people will start asking questions about valuations and sustainability and things like that. And even when things come back, I think it will come back very cautiously. I've read yesterday that companies are very cautious when it comes to making investment decisions. So you might restart the factories, but you will definitely not take very big investment decisions for the next 1 or 2 years. So when capex is going to be so low and economies are going to struggle, markets will come back to their semblance much, hopefully much quicker than, because a very rapid recovery without a proper economic setting is also not a very good news.
Yeah. Okay, so next question that we have from Ali Al-Falej. What's the outlook on gold on the medium to long term?
Gold is always a safe bet in crisis mode times, actually. And normally people give a 5% allocation to gold in their portfolios in normal times. And in abnormal times, it can increase to 20-25% based on your perception of how things are going to unfold. There are still no alternatives to gold as a safe haven. Cryptocurrencies came closer a bit, but now gold is having the typical run that we expect of gold during times like this. Gold is an asset class that doesn't produce any income. The only reason why you go and invest in gold is because you expect more bad news to come. So if you think that things are going to get worse than what it is now, I think an exposure to gold is warranted. Gold is not going to definitely disappoint in terms of losses, but having rallied so sharply in 2020 so far, I think it has got into a bit of a frothy levels. As I have shown in the chart, it is closer to 1 standard deviation. So which probably again says that things have gotten much quicker for gold. But a staggered investment on gold till your fog screen clears is not a bad idea.
Next question comes from Ali, which is a board member with us. What should be
actually? Sorry, it's from another participant.
Okay.
Dana, I don't want to pronounce the name wrong. It's this question.
It says, what should be ideal investment strategy for individuals during this crisis time?
Yeah, the strategy should be that stay in cash at least to the extent of 30%, and look for quality companies that has strong brands. Normally, they are beaten down in conditions like this. So when you have some exposure to equities, expose yourself to such quality names because they can come back much faster and they can withstand the market pressure much better. So market leaders, brand leaders, quality-oriented companies should be the ones that you should go and hide behind, but on the back of very good cash levels. Cash is king. In crisis times like this, it is never a good idea to be 100% invested.
Okay. Next question comes from Mamoon Burhan. It says, with respect to your comment on expanding fiscal stimulus by GCC countries, he agrees that it is needed. However, we've seen that even in US and UK, fiscal stimulus has had a limited impact despite the furloughs and helicopter money dispersed because demand isn't picking up, especially in retail sector. So do you think that it would have a significant impact in this region?
Retail may not be a very good proxy to look at because retail requires footfalls to come back. And footfalls will come back only when you lift lockdowns and when you have normal transportation back running. So till that time, I don't think that is going to be a very effective benchmark to look at. But having said that, let's take the case of small and medium enterprises, for example. Now, they don't have any business for the last 2-3 months, and they have to pay rent and they have to pay salaries. Just because you lower the interest rates so that they can go and get a low-cost funding from banks, or banks say that you don't have to pay interest for the next 3 months and after that you can pay. That's not probably the solution to the problem, because this problem is a very unique problem where companies are almost closing down because of the weight of the problem. There is a survey in Kuwait undertaken recently which showed that more than 40% of the companies are expected to, small and medium enterprises are expected to close because they can't pay salaries and rent beyond what they've been doing. So you need fiscal support in this scenario for you to bring the confidence back in the system. So a mere waiver of interest rates or marginal tinkering of rates is not going to be the solution. I know that US and UK have experimented with fiscal, Germany, Japan. You have hundreds of good cases studies that have given direct support to the businesses. And if you're, imagine fiscal to be a direct support and monetary to be an indirect support. So in a situation like this, I would assume that a direct support, if you can afford, should be the best way to go about it. Take the case of India, for example. Indian stimulus package is about 10% of GDP, but again, bulk of them in the monetary and very little in fiscal. That is because their headroom on the fiscal is very limited, and therefore they cannot do much even if they wish to do much or put cash directly into the pockets of the people. But of course, they are trying to do that in other ways, but with the very limited effects. So I think the best solution to this problem is fiscal, and that requires some bold political decision, which is required in this environment.
Thank you. So the next question is on the grounds of the digitalization and what's happening. I mean, just to add to that point is we've changed a lot. Our behavior has changed. The last time we used cash here, I can't remember even fueling the car is through an app today. So the question comes from Hanan Nasser saying, thank you for the presentation. Based on your view, do you think that cryptocurrency may get more demand?
Yes, definitely. Cryptocurrency will not only get more demand, but will also get more, backing because it might be at the heart of the digitization process. But it will not happen in the informal sector that we have seen so far. When cryptocurrencies move to the formal sector and gets the attention of, say, central banks and government, then it might take a much different form than what we are expecting or what we are seeing now. So as a concept, the technology behind cryptocurrency might be exposed and exploited at a much faster pace by actors who are more credible than what we have seen so far. So far, it's been a very small time underground play by WizKids, but that will change. And then you will see some serious actors coming and embracing the technology behind cryptocurrency in the digitization process, especially the blockchain.
Yeah. Thank you for that. I don't see any more questions. Does anyone have any more questions? Just please post it now. In the meantime, I would like to thank our members again, the attendees, and a very big thank you to Mr. Raghu. I mean, this has been really informative. We really liked it, and excellent presentation. We have one request saying that if it's possible, please share the presentation slides. So if people can post their email and you don't mind, we will share the slides with all attendees or whoever we have their emails. On another note, going forward, we will have certain events. It's a webinar, and we'll see.
We have one more question.
There is one last question.
Yeah, from Hassan Satar. I'm just waiting for him to type it out.
Sorry, so let's take that question.
Hassan Satar, please write your question.
If you want, you can give him the mic as well.
Hold on.
Hassan, we'll give you the mic. Just a second.
Assalamu alaikum.
Alaikum salam.
Okay, great. Thank you very much for your presentation. I just want to ask your opinion with regards to. So you mentioned that we should be more wary in terms of investing in the market, and that we should invest or look to allocate assets or investments towards companies that are more defensive, who have survived similar events or similar hardships, etc. So my concern is, it's just looking for your view, because everyone has this concern, is that since the market has already adapted and looked into those sectors or those defensive stocks, and meaning that the pricing would be more on the overvalued side rather than the value aspect of it. So how can we dodge that bullet in terms of if market correction kicks in very hard, or other economic downturn happens, and plus all of the uncertainty going on right now, how would you propose someone would defend his portfolio against those uncertainties?
Yeah, as I said in my presentation, there is a chart that gives the performance of sectors. Again, you can see a V-shaped line for many of the sectors, but some of them are above the water, like for example, healthcare or technology. They are all in the positive territory. And then you have down the line energy and financials, which are still deeper down the water. So, that a pandemic like this, non-cyclicals and technology, healthcare, cloud computing, these sort of sectors will definitely be a much better call compared to sectors that are directly exposed to the pandemic, like for example, banks or financial institutions or aviation or retail or whatever. So you need to do an aggressive sector reallocation. And as if there is going to be a downfall in the market, it's these COVID-resistant sectors that will fall less compared to COVID non-resistant sectors. So at the heart of your strategy, you should overweight COVID-resistant sectors and underweight COVID non-resistant sectors, so that you can be protected if there is going to be a sudden and deep downside to the market.
Okay, I think with that is the last question that we had. Just let me just make sure the chats are there. Okay. Thank you very much again. The board of Bahrain Economist Society, the attendees, and everybody's thanking you. I mean, everybody's writing it on the chat as well. Thank you very much. It's been really informative, and it's really intriguing, and you make us think about a lot of things going forward. Thank you again.
Thank you, Sami. Thank you, Ali. And thank you, Bahrain Economic Society, for giving me this opportunity to chat with all of you.
Thank you.
Stay safe and stay blessed.
Same to you. Thank you, guys.
Thank you.